While every news channel is telling you to panic about the economy, the wealthy are quietly getting ready to make a fortune. The headlines are screaming about market crashes, inflation, and layoffs. They're designed to make you scared, to make you sell, to make you retreat into a shell. But what if their playbook wasn't some big secret? What if this exact period of economic fear is by design the single greatest wealth-building opportunity of the next decade? In the next few minutes, I'm going to break down the strategies they use to build generational wealth during downturns and how you can do the same. This isn't about complicated financial jargon or needing $1 million to start. It's about a fundamental shift in how you think, followed by a series of deliberate, calculated moves. While the masses are driven by fear, a small, informed group operates with a clear plan. By the end of this, you will have that plan. Let's get one thing straight. A recession doesn't destroy wealth. It simply transfers it. It moves wealth from the impatient to the patient, from the uninformed to the informed, and from those who react with their gut to those who act with a strategy. Every few years, when the economy hits a rough patch, we witness a massive legal transfer of wealth. The media's 24/7 panic cycle plays a huge role in this. They cook up a symphony of fear, throwing around phrases like unprecedented times and economic collapse. This narrative serves a purpose. It gets everyone to panic together. And when people are scared, they do predictable, irrational things. They sell their investments at a loss, hoard cash that gets eaten by inflation, and put their dreams on hold, waiting for a certainty that never comes. But the wealthy, they hear a completely different story. To them, bad news is an investor's best friend. As the legendary investor Warren Buffett wrote during the chaos of the 2008 financial crisis, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. He knew that widespread panic was creating a once-in-a-generation buying opportunity. While everyone else was running from the fire, he was running toward it with a bucket, ready to scoop up assets at a huge discount. Think about 2008. It was terrifying. Banks were failing, people were losing their homes, and the market was in a free fall. It really felt like the financial world was ending. Yet, in the middle of all that chaos, smart investors were making moves. They were buying up shares of solid companies for pennies on the dollar. They were acquiring real estate from sellers who were forced to sell. They were even starting businesses that solved the new problems everyone was facing. Companies like Uber and Airbnb were literally born from the ashes of that crisis, created by founders who saw opportunity where everyone else saw despair. Those who bought American stocks back then, as Buffett advised, saw enormous profits as the market eventually recovered. This isn't some dusty history lesson, it's a recurring pattern. Recessions are a feature of the economic cycle, not a bug. They're the natural mechanism that clears out the excesses and rewards those who were prepared. The real danger isn't the recession itself. It's sitting on the sidelines and following the panicked crowd. The biggest risk is believing the story that your only option is to hide and wait. Because while you're hiding, others are out there planting the seeds of their future fortune. The choice you have to make right now is whether you'll be a victim of this wealth transfer or a beneficiary. And that choice starts with your mindset. Before we talk about a single dollar, a stock, or a piece of property, we have to tackle the most important step, a radical shift in your mindset. You can't execute a wealthy person's strategy with a fearful person's outlook. The two groups are separated by one core belief: how they see a downturn. So how do you make that shift? You start by changing the story you tell yourself. First, you have to reframe the narrative. The media calls it a crash. You need to start calling it a sale. It's really that simple. Imagine your favorite store suddenly announced a 50% off sale. Would you panic? No, you'd rush in excited to buy the things you've always wanted at a steep discount. A recession is a sale on assets. The stock market is on sale. Real estate is on sale. These are the same assets everyone considered too expensive just a year or two ago. Now, because people are scared, you have the chance to buy them at a marked down price. Second, you have to switch from thinking like a consumer to thinking like an owner. In a recession, the consumer cuts back. They cancel Netflix, eat out less, and delay vacations. They operate from a place of fear. The investor, on the other hand, is thinking about what to buy. They see the downturn not as a threat, but as an opportunity to increase their ownership in the world. They know that every dollar they use to buy an income-producing asset during a downturn is a dollar that will work for them for the rest of their life. This is the core of what Robert Kiyosaki, author of Rich Dad, Poor Dad, has been preaching for years. Focus on building your asset column, especially when assets are cheap. Third, adopt a long-term perspective. The panic you see in the market is all about short-term thinking. People are obsessed with daily price swings and scary headlines. The wealthy couldn't care less about that noise. They're playing a different game, one measured in decades, not days. They know that every major market downturn in U.S. history has been followed by an economic recovery and a new market high. Of course, some recoveries take longer than others, and patience is key, but the long-term trend has consistently been upward. By focusing on a 10, 20, or 30-year horizon, the day-to-day chaos becomes irrelevant. It's what allows you to hold firm when everyone else is jumping ship. Finally, you have to learn to be a contrarian. This is perfectly captured in Warren Buffett's famous line, "Be fearful when others are greedy, and greedy when others are fearful." This isn't just a clever quote. It's a battle-tested strategy. When the market's booming and everyone is bragging about their crypto wins, that's the time for caution. That's when others are greedy. But when the market's crashing and your friends are telling you to sell everything, that is your signal to get greedy. That's the moment of maximum financial opportunity. Being a contrarian means having the courage to buy when everyone is selling. It's about making decisions based on logic and history, not fear. You have to learn to love the fear in the market, because that fear is what creates the discount. Okay, with our mindset aligned with opportunity, it's time to execute. But you can't play offense if your defense is weak. You can't seize opportunities if your own financial house is built on sand. So, the very first step isn't to go hunting for investments. It's to build an unshakable financial fortress. This fortress gives you the stability to weather any storm and act decisively when others are paralyzed by fear. This fortress is built on 3 pillars: a large emergency fund, 0 high-interest debt, and total control over your cash flow. First, the emergency fund. You've probably heard the advice to save 3 to 6 months of living expenses. In a shaky economy, that's just the bare minimum. We're not aiming for minimum. We're aiming for financial power. The goal for this playbook is to have a minimum of 6 to 9 months of essential living expenses saved in a high-yield savings account. Let's be clear. Essential living expenses means only what you absolutely need to survive: housing, utilities, food, transportation, and insurance. It doesn't include going out, entertainment, or subscriptions. Calculate this number with precision. This is your survival number. This fund is your ultimate safety net. It's what lets you walk away from a terrible job offer if you get laid off. It's what covers an unexpected medical bill without forcing you into debt. And most importantly, it's what prevents you from ever having to sell your investments at the worst possible time to cover an emergency. Selling at the bottom is how you destroy wealth. This fund ensures you never have to do that. The second pillar of your fortress is waging war on high-interest debt. I'm talking about credit card debt, personal loans, anything with an interest rate over 8%. This debt is a cancer on your finances. In a recession, it becomes even more dangerous. The strategy is simple. Attack it with relentless focus. Use the debt snowball or debt avalanche method. Pick one and stick to it. Every dollar you send to a credit card company is a dollar you can't use to buy an asset that makes you money. Wiping out this debt is like giving yourself an instant guaranteed return on your money. The third and final pillar is mastering your cash flow. You can't save or invest if you don't know where your money is going. This is about becoming the CFO of your own life. Track every single dollar for at least a month. Use an app, a spreadsheet, whatever. The tool doesn't matter. The clarity does. Once you see where your money is going, you can get intentional. This isn't about being cheap. It's about being efficient. Figure out what you truly value and spend lavishly on that, while mercilessly cutting costs on things you don't care about. Negotiate your bills, cancel unused subscriptions, and find ways to free up capital. By creating a big gap between what you earn and what you spend, you generate the surplus that will become the raw material for building your fortune. With deep cash reserves, zero high-interest debt, and strong positive cash flow, your fortress is complete. Now you are financially and psychologically ready to go on the attack. With your fortress secure, it's time to go on offense. This is where you actively build wealth. While others are hiding, you, with your prepared mindset and stable finances, will calmly and systematically buy assets at a discount. This is the be greedy when others are fearful phase in action. Our two main battlegrounds will be the stock market and the real estate market. Let's start with stocks. A bear market is a gift. It's the stock market's version of a Black Friday sale. Your goal is not to time the bottom. That's a fool's errand and nearly impossible. Instead, your strategy is simple and proven. Dollar cost averaging, DCA. This just means you invest a fixed amount of money at regular intervals, no matter what the market is doing. Say $500 on the first of every month. When the market is down, your $500 buys more shares. When it's up, it buys fewer. Over time, this averages out your cost and makes sure you're buying more when prices are low. It takes emotion out of the game and turns volatility into your friend. So what should you buy? In a recession, you focus on quality. First, consider broad-based index funds like an S&P 500 fund. Warren Buffett himself has recommended this for most people. It gives you instant diversification across 500 of the biggest and most resilient companies in America. It's a simple, low-cost way to bet on the American economy as a whole. As the economy recovers, these giants will recover, and so will your investment. Second, for those willing to do a bit more homework, look at high-quality individual stocks in defensive sectors. High-quality companies have strong balance sheets, low debt, and consistent profits. Think about companies that sell things people need no matter what. Consumer staples like food and household products, healthcare, and utilities. People still buy toothpaste, take medicine, and turn on the lights during a recession, making these companies' revenues more stable. Third, look for reliable dividend-paying stocks. These are often mature, stable companies that pay you a portion of their profits. During a downturn, these dividends provide a steady stream of cash you can use, or, even better, reinvest to buy more shares at cheap prices. Now for our second battleground. Real estate. A recession, especially one with higher interest rates, can create amazing opportunities. It cools down the market, sidelines unprepared buyers, and can cause prices to drop. This shifts the power from sellers to you, the buyer. One of the best strategies is buying rental properties. When you buy a rental, you're buying a stream of cash flow. In a recession, you'll find more motivated sellers. Your goal is to find a property where the rent you collect covers the mortgage, taxes, insurance, and maintenance with money left over. That positive cash flow is your main prize. Any appreciation in the property's value is just a bonus. Another great strategy is house hacking. This is where you buy a multi-unit property, like a duplex, live in one unit, and rent out the others. The rent from your tenants can cover most or even all of your mortgage, letting you live for free or for a fraction of the cost. This crushes your personal expenses, freeing up even more cash to invest. The key to buying assets in a recession, whether it's stocks or real estate, is to remember you're buying for the long haul. You are acquiring pieces of valuable, income-producing assets at a time when the market has foolishly undervalued them. This disciplined, offensive strategy is the engine that will drive you toward millionaire status. This third and final piece of the playbook is often overlooked, but it's the most powerful wealth accelerant there is. While building your fortress and buying assets are crucial, the fastest way to get rich is to dramatically increase your earning power. A recession is the perfect time for this. Warren Buffett has said that the best investment you can make is always in yourself. This is all about multiplying your income. You can't rely on a single source of income, especially a job that could be vulnerable in a downturn. The goal is to build multiple independent income streams. First, recession-proof your main career by making yourself indispensable. Look around at your job. What are the biggest problems? What are the most valuable skills? Start thinking like a business owner. How can you increase revenue or cut costs? Go to your boss with solutions, not problems. While everyone else is trying to fly under the radar, you become the go-to problem solver. This makes you the last person they'd ever want to let go. At the same time, you need to be skill stacking. This means combining several skills to make yourself uniquely valuable. You don't need to be the best in the world at one thing. You just need to be pretty good at 2 or 3 things that work well together. For example, if you're a good writer, learn SEO. Now, you're not just a writer, you're a content strategist who can drive sales. If you're a programmer, learn project management. Now, you're not just a coder, you're a potential team lead. Use the slowdown to invest in yourself with online courses, certifications, or books. Next, you start building your own income streams, totally separate from your job. A recession is the perfect incubator for a side business. Think about the businesses that boomed after 2008. They solved a problem the recession made worse. People needed extra money, so Uber was born. People needed cheaper travel, so Airbnb was born. What problems exist today? People need to save money. Businesses need customers. People are stressed. Start small. Can you offer a service based on your skill stack? Freelance writing, web design, or consulting can all be started with almost no money. The goal isn't to create a unicorn overnight. The goal is to create an income stream of $500 a month, then $1,000. That extra income is pure fuel for your investment engine, allowing you to buy more assets and accelerate your path to wealth. By increasing your value, stacking skills, and building your own income streams, you create a personal income machine that doesn't depend on the whims of an employer. You take back control. I know what some of you are thinking. The gears of doubt are turning. This all sounds great, but let's tackle those buts right now, because they're the mental roadblocks that keep people stuck. The biggest one is, but I don't have any money to invest. If this is you, your first priority is Section 3 and Section 5 of this playbook. Fortify your finances and boost your income. Focus all your energy there. Even an extra $200 a month is a powerful start. You don't need a fortune to begin investing. You can start with $50. The key is not the amount, it's the habit. The habit of consistently putting money to work is far more important than the initial sum. Just get in the game. The next objection is, but it's too risky. What if the market crashes even more? This comes from fear and a short memory of history. While past performance is no guarantee, every single market crash in U.S. history has been followed by a recovery and a new all-time high. Will it dip further after you buy? It might. That's why we use dollar cost averaging. If it goes down more, your next purchase is an even better deal. The real risk isn't being invested during a downturn. The real risk is sitting on the sidelines in cash while inflation eats your money and then missing the powerful recovery that follows. Finally, there's the emotional one. But I'm just too scared to invest right now. That's a valid feeling. Fear is a powerful emotion. This is exactly why step 1 is building your financial fortress. That 6 to 12 month emergency fund is your courage fund. It's your psychological safety net. Knowing you can handle any emergency allows you to look at your investments with logic instead of fear. You can afford to be patient because your daily life doesn't depend on the market's mood swings. The fear you feel is a signal that everyone is scared, and that's precisely why the opportunity exists. Acknowledge the fear, but don't let it make your decisions. Let your plan make your decisions. These buts are just stories we tell ourselves to justify inaction. The difference between those who build wealth in a recession and those who don't is the ability to push past those excuses and act anyway. If you're getting value from this and you're ready to stop following the panicked crowd, do 2 things for me right now. First, hit that subscribe button and turn on notifications so you don't miss what's next. Second, I know this is a lot to take in. To make it easier for you, I've put together a free 1-page checklist called the Recession Millionaire Playbook. It breaks down every step we talked about today. To get it, just click the first link in the description below. Download it, print it out, and use it as your roadmap. We are living through a monumental time. For most people, this will be a period of financial pain and anxiety. But it doesn't have to be that way for you. You now understand the truth. Recessions don't destroy wealth, they transfer it, and you now have the playbook to position yourself on the receiving end of that transfer. Here's the mission. First, you will build an impenetrable financial fortress by stacking cash and destroying debt. This will give you the stability and courage to act. Second, you will go on a disciplined offensive, using the fear of others to systematically buy discounted, high-quality assets for the long term. And third, you will invest relentlessly in your greatest asset, you. You'll multiply your income streams and take control of your earning power. The next wave of millionaires won't be made in some future bull market. They will be forged right now, in the depths of this uncertainty. The opportunity isn't coming, it is here. You have a choice. Will you follow the herd, or will you use their fear as the foundation to build your fortune? The playbook is in your hands. Now go and execute.